All right, guys, welcome back to Money Matters. Today we're going to discuss small cap index funds or ETFs. And joining us today, we got my friend Chris and my friend Ben. So they're going to ask some questions in the middle if they have any questions they want to get more detail about. So today I just picked 5 different small cap ETFs. There's no particular order. There's not a reason for them. It's just those are 5 of the most popular ones. And here I wrote down what their description is, their expense ratio, which is important, the price they were trading at, 10-year return, some comments that I wrote down there, and if they pay a dividend, what has been their average for the last 12 months. So for the first one, it's IWN, that's iShares Russell 2000, and I like to use Morningstar for some more in-depth research on these. So the first one's IWM, trading at $230. Here you see the expense ratio, 0.19. And the expense ratio is the fee that the manager of that fund charges to be in that fund, and that's going to be charged at an annual basis. The category is a U.S. fund small blend. If you go over to portfolio, you can see what's in it. So it's 98% into U.S. equity, 0.91 into non-U.S. equity, has a little bit of cash, and that's when you see any fund have some cash on hand, that's because they want to have some cash on hand to get into a position if they want to, if they see an opportunity. I also like to look at the market cap, and here you have a comparison of the different levels of market caps, what the fund has it in, category average to funds similar to this one, and the index that is tracking it. So this one's being compared to the Russell 2000, which is a small cap index. And as you can see, this particular fund traces it very, very closely. So you got almost 13% mid cap. The majority is in small cap, almost the same here, and a little bit in micro.
Now, what does it mean when it's a micro? Like,
So
is that something that's maybe like $10 a share and under, or maybe even smaller than that?
Yeah, so that depends on the market cap, right? So the market cap is determined by the price of the shares times the outstanding shares. So here, let me show you an example. This one's a large cap. This is AMD. So it's trading at $81.55. And then if you go over to statistics and go over here to share history. So shares outstanding. So it has 1.22 billion shares. So if you multiply that times the share price, you would end up with the market cap. So now there's shares outstanding, and then some of them are going to be held by institutional or the company itself, right? So when a company announces a share buyback, it means they're going to go out to the market and buy from the outstanding shares. This makes the pool of outstanding shares smaller, therefore, in essence, driving the price up. Because now when, let's say, 1 million people are buying and selling this stock, but now you're removing 200,000 shares from the market, there's less shares to trade from. So with that scarcity comes technically a higher price.
I've heard of that before, where companies do like a buyback,
right?
But never really understood like the mechanics.
Right, and then if they want to raise some capital, they'll issue shares. Okay, so here we have a sector breakdown of the fund. These are the 11 sectors that are available. So the companies would fall in between one of these. And this is where you can see how heavily exposed they are to one particular sector or not. Then further below, you can see their holdings. And here you'll see what company usually is the top 50 that you get for free here. Top 30. And it'll tell you what company they're holding and the weight that it has in their portfolio. So this particular fund has 2,036 equity holdings. So it's very, very broad, very wide. So it has very, very small holdings, or divided the entire fund into these 2,000 different companies that mostly are small cap.
That's really diverse. Shit.
Yep. So another thing to look for here is performance. So here on the performance, you have, they like to give an example of a decade's worth of historical data. If you were to invest $10,000 into each, either the IWM fund, the Russell 2000 index, or a similar fund category, after 10 years, that $10,000 would grow into these three numbers respectively, right? So this shows you that the IWN over the last 10 years has by a very small margin beat the index of the Russell 2000, but it's beat the different funds in that category. And then a metric I like to use a lot is the total return on the price, and that's a good benchmark is a 10-year, because it shows you, it's been a decade and they've averaged 13%, which is a good sign, whereas other funds in that category have averaged as low as 1. So they've, even over a decade, they've beaten the index by almost 0.20. All right, so next one is SLY. So we have it over here. This is one from SPDR. It's an S&P 600 small cap ETF. So here in the performance, you can see it better that this particular fund beat the index by a lot more. So when you see this is a good sign. Now over the last decade, it's gotten a 14% return, so it's a little bit higher than the IWN we just looked at. So here you have to take into consideration the expense ratio, right? So when you're looking at these, right now the SLY is looking like a better option, right? It has a lower expense ratio and it has a higher return over the last 10 years. Now it's also paying dividends. So this one's paying 0.93.
What's the expense ratio again?
So expense ratio is there's a manager or a team of managers that are a fund is running this particular ETF, right? So they go in, they do analysis, they determine when it's time to sell or buy stocks within this fund. So they take a piece of that commission and they calculate it under the expense ratio. So in order to keep this fund, getting good gains and getting good performance, there's a fee that, whenever you hold any of these ETFs, you're going to pay that fund, the manager, for the performance and everything.
Wait, so who's paying it?
We are,
company?
as the investors. So the way to look at it, right, is for every $1,000 that you spend, you're gonna pay. In this case, it'd be $1.50. So you're like, oh yeah, it's nothing. But people, don't realize that as this portfolio grows, that number's gonna get bigger and bigger, because now it's not, 0.15 of $1,000. It's 0.15 of 100 grand, 200 grand, and so forth. So, I mean, these are all pretty well priced, but especially in the 401ks, sometimes you need to look at these, because one of the more actively managed funds will have, 0.95, 1, and that turns into bigger money. So that 1% would be $10 every $1,000. So if you multiply that times a bigger portfolio, it's a big chunk of change per year that you're missing out on. So it's something you want to keep in mind.
Now, what would you say would be like a good, like if someone were to go like all in on different ETFs, what would you say would be like the right recommended blend between small, medium, and large cap?
Right. So that's a good question, right? So it depends on your investing goal. You got to consider how long is your time horizon? How much time do you have? The small caps are usually going to be a little bit more riskier because they're growing companies, whereas the large cap are more established companies like Microsoft, the Apple, the Tesla. So it's a safer bet to go into large cap. But if you are a young investor, you can afford more risk based on your investing goals, then you might want to be a little bit heavier on the small cap. And it's not necessarily true, right? Because like if you compare large cap ETFs, they're very close to small caps as far as the 10-year return goes. So it depends. You have to do some research, run some numbers, and see what's right for you. But it's, look out for the best performing fund, low expense ratio, and then have a little bit of diversity, right? Because let's say in the next 10 years, if a lot of small companies come out, that those small ETFs are gonna get you bigger gains, right? So if you look back probably 10, 15 years ago, imagine a small cap ETF that had Amazon in it, Apple, Google, and the growth that they've had over, the last 10 years, 15 years, growing from a small mid cap to a large cap. In that ETF, you're going to capture all those gains. Whereas I think large cap, it grows, but I don't know if that exponential growth is there. However, they are steadily growing. A lot of people have large cap indexes in their 401ks that they put heavily on. And even like a lot of the target fund dates that are available in the 401k have that. And that just means that money's being pumped into those funds, AKA those companies, every Friday or every other Friday. When people get paid and they get their 3 to 6% to go towards their 401k, that fund's going to buy more Apple stock, more Microsoft stock, more Amazon, Google, all these companies. So it's money that keeps flowing into these particular stocks.
So should you diversify, like have big stock or big cap and small cap? And
yeah, definitely, look at, I would say, like for me, I think in my opinion, right, like I would do probably like a 35% small cap, like another 30 large cap, maybe another 10, 15 mid cap, and then a little bit of international exposure. And then like right now I'm looking for a couple of small cap companies, just single stocks to sprinkle into the portfolio there.
Right.
Companies that I believe in and that they're going to grow, because that's where you're going to get your biggest gains, right? So the ETFs are great because they give you a balanced diversification, and it's going to grow steadily, that 13%, for example, over the next decade, hopefully. Again, past returns don't mean future returns, but if they can perform with the index, and the market average has been over the last 30 years about 8%, 10%. If you're averaging that money's growing, and then if you can sprinkle in a couple of small caps that do good, that's going to boost your return.
Okay, so expense ratio in compared to small cap, mid cap, and large cap, is there any difference? And ETFs that heavily follow, an index or several indices, could that be perceived as a good and a bad thing because it's very heavily reliant on one index in particular, and maybe if they want to outdo them, it kind of limits or hinders their ability to do so because they're so heavily reliant on one specific index?
Great questions. So the first one, right? So does the expense ratio matter if it's small, mid, or large? No, the expense ratio most likely is determined by the amount of turnover that fund has. So if it's a fund that has heavy turnover, meaning it's very actively moving funds in and out, or companies in and out of its fund, then that will more than likely incur more fees, hence drive up the expense ratio. Okay. And you can find that here, right? So if you go to Morningstar, you go to portfolio, you'll see here they have reported turnover, 15%. So that means, I guess, over the course of a year, they'll turn over about 15%, which is not too bad. Whereas and I'll pull up the last one here so you can see the amount of turnover there and see the correlation, right? So let me pull that one up. It's URTY. You go to portfolio under URTY.
Now, what's like a good sweet spot number for turnover? I'm guessing that's depending on how many holdings they have, right?
Yeah, so this is a percent, right? So that's something you have to keep in mind, because doesn't mean that they turned over 68. It means they turned over, out of, like in this case, out of 2,000 equity holdings, they're turning over almost 70% of those. So this is URTY, which has an expense ratio of 0.95 compared to the one we were looking at before, which is the SPDR has a a fractionally smaller expense ratio, but the turnover on that one is 15%. So this is another one that tracks the Russell 2000, right? This is Vanguard's version of it. Has a 0.10 expense ratio, which is very low, which is good. They have a annual yield average of 1.07. Let's take a look at performance. And this one's very tight to the index, right? So again, so far the SLY seems to be outperforming these same category funds, because this one's tracing the index almost perfectly, just like IWN was. So let's take a look at the portfolio, see how much the turnover is. 19% turnover. So that's interesting, right? So this one has a higher turnover than the SLY, but yet a lower expense ratio. All right, so they have a lot more equity holdings. Let's take a look at the market cap. Okay, yeah, so they're tying really close to the index, and that explains why they're so close when compared to the index. And these are very similar, right? So like all these indexes are gonna have, in the small cap right now, the Russell 2000 has, I guess, good exposure to, let's see the index. Yep, it's almost tying perfectly to the industry breakdown for the Russell 2000. So this one, the Vanguard, this one doesn't really follow the index, and that's why this one has outperformed it a little bit. Not as much as the SLY. This one's at 13.53 over the last decade. The SLY was at 14 and change, so still the SLY has a better performance over the last decade. And again, this one's not tracing the index. This is just an ETF that's focused on mostly small cap companies. And here you can see they're heavy in mid cap. Their mid cap is almost the same weight as their small cap. And Chris, you had asked earlier, like, is can they have big weight other than small cap, or why would this have a big mid cap concentration here? Part of it could be because a lot of their small cap picks have grown into mid cap. So as soon as they cross over that threshold, Morningstar or whatever financial analytical will have them classified as a mid cap now. So this Vanguard one has a turnover of 22%. So I like looking at this as well, because you can find, if you're looking for individual companies, this is a good spot to look at.
Yeah.
It'll show you, these funds are investing into these, and as long as they stay up here and they're weighted heavily, this company's going to invest and keep pouring money into these companies. And then here you have your PE ratio, price to earnings. So the lower the number is here, the better, because it means it's trading closer to being, undervalued, meaning it's a good buy, right? So if you can find undervalued companies, it's a good thing because they have opportunity to grow.
All right. So what are the clues that a company is undervalued?
The biggest indicator is the PE. So it's the price to earnings. So
do I want a larger PE or PE?
No, you want a smaller PE, right? So it's a division of the price versus the earnings. Like if that stock is trading at $10, right, and they're earning $1, then their PE ratio is 10. So they're trading 10 times above their earnings per share. So the smaller the number, the better. All right, last but not least, we have URTY, ProShares Ultra Pro Russell 2000. So this one's definitely more active. As you can see, the expense ratio here. So this is going to be a definitely more aggressive fund. So here you can see the volatility, right? So when you compare this fund, is ETF, is the blue line. Now, if you had invested $10,000 back in the beginning of 2011, here's a breakdown, right? So at the end of 2020, you would have 60 grand. So it heavily outperformed the Russell 2000. Now, this one's more volatile. As you can see, that blue line is all over the place, right? And this has to do with the leveraging. So it has derivatives in it. That's why you see a lot of volatility. If you look at the red line, which is the Russell 2000, which is the benchmark for this fund, it has its waves, but it's for the most part steadily climbing up. And of course, here at the beginning of 2020, you have the dip in March because of what we already know. But look how small that movement was on the red line versus the URTY fund. A lot of those derivatives probably went out of the money and drove the premiums down, or became invalid because no one wants to buy that contract anymore. So on the portfolio, you can see they have index swaps. So if they are stuck in those contracts, they're going to lose that premium. So that's a big reason why you would see that volatility in here. So this is definitely one that will get you, a more aggressive return if you're looking for that. You just gotta make sure to have the stomach for it, because that's the biggest problem, right? And that's why a lot of people end up not having the nest egg that they want at retirement, or having the portfolio they want. It's because in moments like this, when this loses, looks to be about 70% of the value, people sell there. If they would have just held on through and continued to do what they're doing, let it slide, look where they would have ended up. But yeah, like I always say, guys, time and compound interest are your best friends. There's no need to panic. Just invest diligently, do your research, and stick with your plan. If you have a long time horizon, just wait it out. There's no need to panic. If you're diversified, if you have good fund choices that you've picked, good companies you believe in, stick to your guns and just ride it out. If you have a long time horizon to retirement, until the time you need that money, don't stress out so much.